Imagine this. You wake up one morning, reach for your phone to check your balance, and it says zero. Not low, not overdrawn, zero. You call the bank, and after 45 minutes on hold, someone finally picks up and says, "Your account has been flagged for review. We cannot discuss the details at this time." You ask how long this will take. They say they don't know. You ask if you can access any of your money. They say no. And just like that, the retirement you spent 40 years building, the nest egg you sacrificed and scraped and saved to put together, it is completely unreachable. Not stolen, not lost, just frozen. Sitting there behind a wall of algorithms and compliance protocols and bureaucratic language you never agreed to, never voted on, and never even knew existed. This is not a horror story I made up. This is happening to American retirees right now, in numbers that are accelerating, and the reasons behind it are both more mundane and more frightening than most people realize. Today, I want to walk you through exactly what is going on inside the banking system, why the rules have quietly changed, what history tells us about what comes next, and most importantly, what you can do to make sure this does not happen to you. Let me start with something that most people don't know. Something that was never splashed across the front page of any major newspaper. Something that slipped through the noise while everyone was arguing about politics. The rules governing how banks treat your money have fundamentally changed. Banks now have broad legal authority to hold, delay, flag, restrict, or outright freeze access to your funds for reasons that range from legitimate fraud protection all the way down to an AI system deciding your spending habits seem a little different this month. And once that flag gets triggered, the burden is not on the bank to prove you did something wrong. The burden is on you to prove that you didn't. One of the mechanisms driving this is something called the speed bump rule, FINRA Rule 2166, which gives financial institutions the authority to place holds on transactions that they merely suspect might be connected to fraud or financial exploitation of a senior. The intention is genuinely protective. Elder financial fraud is a massive problem, and no one is arguing that banks should ignore it. But here is the problem. The way this rule has been implemented, the word suspect is being interpreted by automated systems, by AI behavioral monitoring tools that track every transaction you make, every time you log in, every time your patterns deviate even slightly from what the algorithm considers normal. Took out more cash than usual because a grandchild was visiting? Flagged. Transferred a large sum to help a family member with a down payment? Flagged. Didn't log into your account for a year because you were traveling and using a different card? Flagged. In each of these cases, the bank has the legal authority to hold your money, sometimes for days, sometimes for weeks, sometimes indefinitely while the matter is reviewed. And then there is what some are calling the KYC refresh lockout. Know Your Customer rules, KYC, require banks to periodically verify the identity and documentation of their account holders. If you have not updated your identifying information in their system recently, and they decide it's time for a refresh, and you miss the notification, or it goes to an old email address, or they simply decide their records are outdated, your account can be restricted until you physically come into a branch or submit documentation to prove you are who you have been for the last 30 years. For elderly Americans who may have limited mobility, who may live far from their nearest branch, or who simply don't check email regularly, this can become an incredibly disorienting and frightening experience. Now, I want to be clear about something. I am not here to tell you that every bank is malicious or that every account freeze is some coordinated conspiracy. Many of these freezes are accidental. Many are the unintended consequences of well-intentioned rules colliding with the crude reality of algorithmic enforcement. But here is what I need you to understand. It does not matter whether the freeze is intentional or accidental when you cannot pay your electric bill. It does not matter whether the algorithm was trying to help you when you are standing at a grocery store checkout line with a cart full of food and a card that won't work. The practical result is identical, regardless of the motivation behind it. Your money is inaccessible. And in a world where nearly every single financial obligation you have, your mortgage or rent, your utilities, your insurance premiums, your medical copays, runs through the banking system, even a temporary freeze can cascade into something catastrophic very quickly. Hey, quick aside, if any of this is making you think about how to protect what you've built, I put together a free guide on the saving secrets that thousands of American retirees are using to shield their hard-earned wealth from exactly this kind of banking risk. It's down in the description. Worth a look before you finish watching this. Now, let me take you somewhere most financial commentators won't go, because understanding what is possible in the future requires understanding what has already happened in the past. Not the distant past, the recent past. And the story I want to tell you starts on a small island in the Mediterranean. It was March 2013. Cyprus, a small but prosperous island nation, was facing a banking crisis. Its banks had made enormous bets on Greek sovereign debt, and when those bets went bad, the banks were insolvent. The European Union and the International Monetary Fund stepped in with a bailout package, but the price of that bailout was something that had never been done before in the modern era. Overnight, without warning, without referendum, without any democratic process of any kind, the Cypriot government announced that bank deposits above a certain threshold would be subject to a forced levy. A haircut, they called it, as if trimming a bit off your life savings was the same as getting a haircut. In the case of large depositors at the Bank of Cyprus, ultimately nearly half of their savings above the insured limit was simply confiscated. Not borrowed, not deferred, gone. Converted into bank equity that became worthless almost immediately. And here is the part that should make every American's blood run cold. In the days before the announcement, Cypriot officials, government ministers, their families, individuals with inside information had already moved their money out. The people who got hurt were the regular depositors, the retirees who had saved their whole lives and trusted their bank the same way they trusted the sun to rise, the business owners who kept operating capital in checking accounts, the ordinary people who believed, as most of us do, that the bank is the safest place for your money. They woke up one morning and discovered that belief had cost them dearly. Now, here is the question I want you to sit with for a moment. Could something like that happen in the United States? And the uncomfortable answer is that the legal architecture for something very similar already exists. Under the Dodd-Frank Wall Street Reform and Consumer Protection Act, which was passed in the aftermath of the 2008 financial crisis, American banks are subject to what are called bail-in provisions. The idea behind bail-ins is that when a bank fails, rather than using taxpayer money to bail it out, what happened in 2008, the bank's own creditors and counterparties absorb the losses. And here is the part of the conversation that tends to make people uncomfortable. Under the legal framework of Dodd-Frank, ordinary bank depositors are technically classified as unsecured creditors of the bank. Your checking account, your savings account, the money you have been putting away for 30 years. In the eyes of the law, from the perspective of a bank resolution proceeding, you are a creditor. You are holding an IOU from the bank, not physical money that belongs to you. FDIC insurance provides protection up to a certain threshold per account, per institution, a meaningful protection, and one that applies to the vast majority of everyday Americans. But for someone who has spent decades building a nest egg, whose retirement accounts, brokerage accounts, and savings have grown beyond those insured limits, or who has assets spread across instruments that are not straightforwardly FDIC insured, that protection has limits. And in a world where the banking system is under escalating stress, where geopolitical tensions are redrawing global trade relationships, where central banks around the world are quietly moving away from their dependence on US dollar reserves, those limits matter more than ever. Let me talk about what central banks are doing right now, because this is perhaps the most telling signal in the entire landscape. Central banks around the world, from China to Russia to India to a growing block of emerging market nations, have been accumulating gold at a pace not seen in decades. This is not a coincidence. This is not a fashion trend among finance ministers. Central banks are arguably the most sophisticated institutional investors on Earth. They have access to information, to economic modeling, to geopolitical intelligence that the average investor never sees. And they are all making the same bet. They are reducing their exposure to dollar-denominated assets and increasing their exposure to physical gold. When you ask why, the answer they give publicly is hedging and diversification, but the behavior tells a deeper story. They are hedging against a scenario in which the dollar's global dominance erodes, in which the debt that the United States has accumulated over decades becomes impossible to sustain, in which the financial system undergoes a structural reset of the kind that tends to happen once or twice per century. Gold has crossed all-time price records in recent memory, and silver, the historically undervalued cousin of gold, has arguably been even more dramatic in its movement, rising nearly double in price over a remarkably short window. These are not the movements of a niche commodity in a quiet backwater. These are the movements of assets that millions of people are rushing towards simultaneously, because they have looked at the banking system and decided they need something outside of it. And I understand that, because the logic is actually very simple when you strip away all the jargon. Gold and silver are physical. They cannot be frozen by an algorithm. They cannot be locked behind a KYC refresh requirement. They cannot be bailed in to recapitalize a failing institution. They do not require a bank's permission to exist. When you hold physical gold in your hand, that gold is yours in a way that a number on a bank's balance sheet is not. It has been yours in that way for 5,000 years of human civilization, through every empire, every currency debasement, every financial crisis, every technological revolution. The Roman denarius is worthless. The continental dollar is worthless. The Weimar mark is worthless. Gold is not. I want to take a moment here because I know some of you watching this are sitting on retirement accounts, 401ks, IRAs, pension rollovers, and you're wondering whether any of this applies to you, whether it's possible to protect that wealth without triggering massive tax penalties, without liquidating everything you've built. And I want to tell you that it is possible. There are legal IRS-approved mechanisms for holding physical gold inside a retirement account structure, what's known as a gold IRA. It lets you maintain the tax advantages of a qualified retirement account while moving a portion of your wealth into physical precious metals that exist outside the banking system, that can't be frozen, that can't be inflated away, that can't be bailed in. If you have significant retirement savings and you're concerned about the banking risks we've been talking about, and you should be, a gold IRA is worth understanding. I'll have more information on this available in the description, but I want you to at least know it exists because a lot of retirees don't. Now let me bring this back to the present, because I want to make sure you understand the specific mechanics of how banks are freezing accounts today, because this is more immediately actionable than anything else I'm going to tell you. Research coming out of financial consumer advocacy groups has identified a pattern of at least 7 distinct mechanisms by which senior bank accounts are being restricted or frozen in the current environment. We talked about the speed bump rule and the KYC refresh lockout, but there are others. There is what's being called the dormancy trap. If you have a savings account you haven't accessed in over a year, the bank may flag it, restrict it, or in some states, report those funds to the state as unclaimed property through a process called escheatment. That money doesn't disappear, but getting it back can take months and involve an extraordinary amount of bureaucratic paperwork. There is the AI behavioral false positive problem, which is growing more acute as banks increasingly rely on machine learning systems to monitor transactions. These systems are trained on statistical patterns, and they generate a certain rate of false positives by design. For most of the population, a false positive is a mild inconvenience, a declined transaction, a quick call to the bank to confirm a purchase. But for a retired person managing a fixed income, a sudden account restriction can cascade into missed bill payments, late fees, damage to credit scores, and in worst cases, the triggering of additional restrictive holds, as the bank's system interprets the downstream chaos as further suspicious activity. And then there is the geopolitical layer. We are living through a period of de-dollarization unlike anything we have seen since the Bretton Woods system collapsed in 1971. The BRICS nations, Brazil, Russia, India, China, South Africa, and a growing number of associated countries have been actively building alternative payment systems, alternative reserve frameworks, alternative mechanisms for conducting international trade that bypass the US dollar. This is not conspiracy theory. It is documented, it is public, and it is accelerating. What it means for the average American is that the dollar's privileged position in the global economy, the position that has allowed the United States to run extraordinary deficits without immediate consequences, is under sustained challenge for the first time in generations. When reserve currencies lose their status, historically that process does not happen slowly. It tends to happen all at once, and the people least prepared are invariably those who trusted the system right up until the moment it failed. Think about what happened in 1971, when President Nixon closed the gold window, when the United States unilaterally severed the dollar's link to gold, ending the international monetary order that had been constructed at Bretton Woods. For most Americans, that moment passed without fanfare. Life went on. The sun came up the next morning. But in the decade that followed, inflation ran hotter than it had in living memory. Interest rates climbed to levels that made mortgages effectively unaffordable for a generation, and the purchasing power of savings accounts was quietly decimated for anyone who kept their wealth sitting in paper dollars. The people who owned physical gold saw their wealth not just preserved, but dramatically multiplied. It was not magic. It was not luck. It was simply the logical outcome of holding an asset that cannot be printed, cannot be debased, and cannot be frozen. What we are facing today has echoes of that moment, but the stakes are higher because the global order is more complex, and the alternatives to the dollar system are more credible than they have ever been. The question is not whether the current financial architecture will face stress. The question is whether you will be positioned on the right side of that stress when it comes. And I want to be direct with you because I think you deserve directness. The most important thing you can do right now is not to panic. Panic leads to bad decisions. The most important thing you can do is to diversify your exposure away from pure dependence on the banking system in a thoughtful, measured way. That means understanding what portion of your savings is actually protected by FDIC insurance and what portion is not. It means making sure your accounts are active, that your identifying documentation is current with your bank, that you are not inadvertently sitting in the dormancy trap. It means educating yourself about what a gold IRA actually is, how it works, and whether it makes sense for your situation. It means thinking about physical precious metals not as a speculative bet, but as what they have always been, the portion of your wealth that exists completely outside the reach of any bank, any government, any algorithm. Because here is the truth that 4,000 years of human economic history keeps repeating. Empires rise and fall. Currencies come and go. Banks open and close and occasionally freeze and sometimes collapse. But gold and silver have never gone to zero. Not once. Not in any civilization, in any era, under any set of circumstances. There is a reason that every central bank on Earth holds gold, even while they talk publicly about the supremacy of fiat currency. There is a reason that when the Cypriot banks froze, the people who had physical gold in their homes did not have to stand in line at an ATM. There is a reason that central banks are buying gold at generational highs instead of waiting for a pullback. They understand what is at stake. The question is, what are you do? If you made it to the end of this video, I want to offer you something. Down in the description, there is a free guide that walks through the saving strategies that a growing number of American retirees are using to protect their wealth from banking risk, inflation, and currency instability. That guide is available to anyone watching this. But for those of you who have stayed with me all the way through, and especially if you are an American retiree with at least $100,000 in any type of retirement account, I want to offer you something additional. Mention that you watched to the end, and you can get access to an exclusive, one-on-one educational web conference, completely free, no obligation. Not a sales pitch. An actual educational session where you can ask real questions about gold IRAs, about physical metals, about what diversification away from the banking system actually looks like for someone in your situation. That opportunity is in the description, and it is exclusively for people who made it this far. You took the time to learn. Now, take the time to act. Your future self will thank you for it.